Hey everyone, welcome back to Corporate Decoder, where we dive deep into the boring stuff so you don't have to. Today we are looking at JP Morgan Real Estate Income Trust Inc.'s latest 10Q filing, and you won't believe what we found buried in these numbers. It's like a treasure hunt in a spreadsheet. So this is a quarterly report that JP Morgan Real Estate Income Trust Inc., or JP Morgan Real Estate Income Trust Incorporated as they're called here, has filed with the SEC. Essentially, it's a financial checkup covering the period up to the 30th of September of 2025. Think of it as a progress report for their real estate investments and all the money stuff that goes with it. Let's kick off with the balance sheet. This is a snapshot of what the company owns and what it owes at a specific point in time. On the 30th of September 2025, their total assets were a hefty $1.288 billion. Now compare that to the 31st of December 2024, when it was just over $603 million. That's more than double its assets in less than a year. Big growth here. The biggest chunk of their assets, around $1.04 billion, is in investments in real estate. This is up from $365 million at the end of 2024. That jump tells us they have been buying a lot of properties. On the debt side, mortgage notes add up to about $266 million. This is also a big jump from $123 million at the close of 2024, which makes sense given all the new properties they are acquiring. Looking at equity, which is basically the owner's stake, they have about $729 million. This is up substantially from $296 million at the end of 2024. Now let's dive into how they performed financially. For the 3 months ending in September 2025, their rental revenue was $22.5 million. This is a huge leap from just $6.8 million in the same period in 2024. This is a direct result of their aggressive property acquisitions. However, they are reporting a net loss. For the 3 months ended the 30th of September 2025, the net loss attributable to JP Morgan Real Estate Income Trust Incorporated stockholders was about $6.4 million. This compares to a loss of $2.6 million in 2024. So while revenue is up, the losses are also growing, which is something to keep an eye on. Notice how the weighted average shares outstanding have jumped from 18,655 in 2024 to 72,503 in 2025. For the 9-month period, this is because they have issued a lot more stock to finance these acquisitions, which can dilute the value for existing shareholders. Looking at the statement of changes in equity, we see a lot of activity. The additional paid-in capital, which is money investors put in beyond the par value of the stock, is over $788 million. This is a massive increase from $329 million at the end of 2024, again showing significant capital raises. They issued a lot of new stock in 2025 to fund their growth. This is common for REITs as they expand their portfolios. While they are growing aggressively and generating more rent, there are still costs associated with acquiring these properties. They have amortization of above and below market lease intangibles, which is a bit of a mouthful, but essentially means they are recognizing the difference between the rent they are contractually getting and what the market rate would be over time. The company has been a buying machine this year. Just in the 9 months ending the 30th of September 2025, they acquired 15 transactions totaling 47 properties. This includes industrial properties, multifamily complexes, and even a single family rental portfolio. Their total purchase price for these acquisitions was over $730 million. The industrial properties alone represented a significant portion of their investments. They added 35 industrial properties covering over 4.7 million square feet. They also expanded their multifamily presence with 12 properties and over 2,100 units. This shows a clear strategy to diversify their real estate holdings across different sectors. To finance all these acquisitions, they have taken on more debt. Their mortgage notes balance has ballooned to around $271 million from $124 million. They also have a repurchase facility of up to $150 million, which they have drawn down to $88 million by September 2025. This facility is used to finance their originations of commercial mortgage loans. And to top it off, they have a $325 million unsecured revolving credit facility, and they've already drawn down $45 million. This shows they are utilizing a variety of financing tools to fund their expansion. Looking at related party transactions, they owe about $27 million to affiliates. A big chunk of this is for operating expenses advanced by the advisor, which they plan to repay over time. They also pay stockholder servicing fees, which can be quite significant for certain classes of stock. These fees are meant to compensate the dealer manager for selling shares and servicing shareholders. The advisor gets a management fee too, which is a percentage of their net asset value. This is standard for externally managed REITs. When we look at the operational performance by segment, the multifamily and industrial segments are driving the highest net operating income. Multifamily brought in over $7.8 million for the quarter, while industrial generated over $6.2 million. The segment for investments in real estate, debt, and securities also shows a positive contribution. Now, a REIT's main job is to generate income for shareholders. So let's talk distributions. For shareholders of Class D stock, the average annualized distribution rate was 4.51%. For Class I, it was 4.49%, and for Class E, it was 4.21%. Looking at total return, if you assume maximum upfront selling commissions were paid, the year-to-date total return for Class D shares was 2.20%, and for Class Y shares, it was a mere 0.26%. This highlights the impact of those selling costs on your actual returns. The company's net asset value, or NAV, is calculated based on the fair value of their assets and liabilities. As of the 30th of September 2025, the total NAV was about $821 million. The NAV per S-share varies by class. For example, Class D shares had a NAV of $10.44. While Class E shares were valued at $11.22. Underlying these NAV calculations are some key assumptions like discount rates and exit capitalization rates. For industrial properties, the discount rate was 8.22%, and for multifamily, it was 7.16%. These are important numbers that influence how they value their properties. Comparing their GAAP stockholders' equity of $729 million to their NAV of $821 million, we see the difference. The NAV is higher primarily because it accounts for the fair value of their real estate and debt, whereas GAAP reporting uses historical cost for many of these items. So what is the big story here, Jay? P. Morgan Real Estate Income Trust Incorporated is in a major growth phase. They have rapidly expanded their real estate portfolio and raised substantial capital to do so. This explains their increased revenues and assets. However, this rapid growth comes with growing pains. They are reporting net losses, increasing debt, and the impact of issuing a lot of new stock is diluting existing shareholders. The aggressive acquisition strategy, while promising for future income, is currently a drain on their finances. Strategically, they are spreading their bets across different real estate sectors, which is good for diversification. The real question is whether their leasing strategy and property management will translate into consistent profitability and positive cash flow in the coming years to justify the losses and debts they are currently taking on. It is a high-stakes game of real estate expansion, and only time will tell if they can convert this growth into long-term value for shareholders. Alright, that is our breakdown of JP Morgan Real Estate Income Trust's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. And don't forget to check out our Discord community linked in the description below for more exclusive content and discussions. Thanks for watching. See you next time.